Jeff, you look at these numbers, and the numbers we're anticipating next week as well, Jeff. Are we set for a hawkish turn from this Federal Reserve?
Well, we are, and we have been for some time as the data has accelerated. You know, first we had the acceleration on the inflation side, and really more than the acceleration, it was just the lack of the deceleration on the inflation story. You know, this morning, and I think you guys have honed in on the key number, the 3-month average printing at 188, the combination of today's upside surprise plus the revisions. You're changing the narrative on the labor side. So the combination, the old story was a weaker labor market, an expectation of falling inflation, and we need these insurance cuts. And as you were highlighting Matt Lizzetti's point, you know, maybe they took out too much insurance. Well, that's kind of after the fact because the facts have changed. So the facts that are changing here is a stronger labor market, a fourth supply-side shock in the form of the war and its impact on oil inflation. And absolutely, we've changed the narrative that's already been in the price. It's going to continue, as you're seeing in the markets here today. And that hawkish turn, as you highlighted, you know, we're going to validate that, you know, with the change in the language in the June FOMC.
Jeff, forgive me, but shifting to neutral doesn't really feel hawkish. Moving to hike and then hike again feels hawkish. Are we going to get that kind of action from this Fed, and how high is the bar for that?
Well, the bar for June is high in that this Fed, you know, wants to move slowly, typically tends to move slowly. And the issue that we're going to have from the Fed perspective is managing the dispersion within the committee. So you're not going to get that clear signal, but the direction of travel is clearly there. The question is, will the Fed get out ahead of where markets are pricing, or are markets going to try to push the Fed? So far, it's the latter. The markets are out ahead of the Fed. And really what we're seeing here, likely to see here, I should say, in the June FOMC is the Fed playing catch-up.
Well, and Jeff, this is the key point that a lot of people are making, is that the Fed's behind and the market's kind of leading the charge. And they're looking at the data and they're saying that there is enough labor market tightness to foster inflation going forward, in addition to supply shocks and this existential spend on AI. Would you bet with the market, or would you bet that the Fed has too high of a bar to actually hike rates based on what the composition of the Fed is and, frankly, what the drivers of inflation really are?
Yeah, you know, we're right on the precipice of pricing in a full hike for this year. So that probably feels about right, given where the data is relative to how lagged the Fed is, and not wanting to be in a hurry for many reasons to move towards a hike. And if they can just hang on to the inflation data, not aggressively reaccelerating upwards, and they're going to need a little bit of help there, and they're getting it from the oil price situation. You know, I don't think they're going to be in a hurry to raise rates, and so pricing in more than that, you know, unlikely. The other point here, and Jonathan usually say, you know, the first reaction is not the last reaction. There are some kind of one-offs in this labor report that is probably overstating that headline. The market's going to react to the headline, but give it some time to look through. You got a government number in there that looks pretty outsized. You got a leisure and hospitality number that looks a little outsized. No doubt this is a strong report, but when the dust settles, it's really going to be about the gradual strengthening in the labor market, and can you see this kind of stabilization in inflation that keeps the Fed from having to move towards a more aggressive tightening phase? I think that's where we'll get to, but again, it depends on, you know, particularly that path of inflation.